look, I want to believe that there's more demand and organic demand than supply, and that we're still on track for higher highs in Q4. I am concerned that the ripping out of the leverage that occurred on Friday and the destruction of that retail cohort may make that pretty impossible. Now, that's the bad news. The good news will be, since we didn't go to 170, we don't have to fall to 65. So we could now just chop around this level. You wouldn't, or you shouldn't, make that trade unless you have better information.
Mark Yusko estimates Bitcoin's current fair value sits around $100,000 to $110,000 based on Metcalfe's law, which values networks according to the number of users and the number of transactions between them. That means that as of right now, with Bitcoin trading around $120,000, $125,000, we're once again slightly above fair value, roughly in the same position we were in late 2021 before the final leg of that cycle's correction. However, Yusko emphasizes a key difference this time. There's less leverage in the system compared to 2017 and 2021.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Long story short, 2017 into 18, right? We have this peak at 20,000 and then go into a bear market. Okay. Then we come back in 21. In 21, fair value was 30,000. Now remember, when Luna hits Terra, things start to get a little bit ugly. But then the FTX thing happens in November. In November, we were all the way to 69K. Fair value is like 32K. We're 2 times fair value, just like in 2017, we're 2 times fair value. Well, when you're 2 times fair value, what has to happen? You have to go back to fair value. Now, what's the trigger? Deleveraging. And the problem is, in both 17 and 21, the leverage was super high. And so we went bam, down 84%, 74%. We went through fair value, we got to cheap, and then the investors come back. At 15K this cycle, the investors, like us and others, come back, and then we start moving back to fair value. Today, fair value is like 105, 110, Metcalfe's law. So here we are, toward the end of the cycle. I would have said, and I actually did say in January, that I thought there wasn't as much leverage this time as the last 2 times. So we were only going to go to 150 to 170, about 50% premium to fair value, which meant we'd have a lower drop. So then what happens? Well, so then this tweet goes viral last week that, hey, this guy tweeted a couple years ago that if you look at the math, it was precisely 1,064 days from 2013 to 2017 peak. Then it was precisely 1,064 days from the trough to the next peak. Precisely 1,064 days was October 6th. And it's based on number of blocks and all that kind of stuff. So it's like, whoa, that's going to be the peak? Like clockwork, 125.6. 4 days later, we get this leverage unwind. Well, wait a second. Now, if we're not going to go all the way to 150 or 170, well, we certainly don't need as big a drop. But we're at 125. If we drop down to fair values, like right where we are, 105, 110, are we just going to be like dead money for a while? I don't know. And now, on the flip side, and you didn't ask me this question, but I'll volunteer it. So on the flip side, there are
I
people.
haven't asked many questions. I want to let you cook, Mark. I'm just listening, and it's all good. So I'm not going to jump in.
On the flip side, there are people who say, no, you're wrong. The cycle is over. Well, why do you say that? Oh, ETF demand, nation state demand, retail demand, Morgan Stanley is saying yes, Vanguard saying yes. Okay, there's some logic to that the institutionalization of the asset will mitigate the volatility of the cycle. Okay, I'll buy that. But here's the problem. We've had this wave of interest that's been promised, and we actually have seen a lot of money come in through the ETFs, for sure.
Yeah.
But as I said, the problem with a lot of that money, it's not net long. It's actually short the other side. It's just an arbitrage, because there is, in the futures market, the future price a month out is higher than the current price. That's just the nature of futures markets. And so there's something called roll yield, where you go long the future and short the asset, and you roll down over the course of the month, and you make, in a good time, 11-ish% annualized, in a bad time, 4 or 5% annualized. But the thing about it is, it's pretty much risk-free because you're dollar neutral. So you can lever that up a decent amount. And if you're making 11% for a month, 11% annualized, but you can lever that up 5, 6, 7, 8, 10 times if you're a big institution.
Yeah.
October isn't happening. Everyone, and I mean everyone, was saying, hey, all we can do is get through, Rectember, and October will be great. Well, when everybody believes something, it usually doesn't happen. And it can be exploited by whales, which is what we saw, this whale that went short on Friday. 1 minute before the announcement. I'm just going to be a betting person that there was some correlation of knowledge there, but whatever. So, but my point there is that Pomp's right. If everyone's projecting a crash, it probably isn't going to happen, but that's not what everybody's projecting. Everyone, and I do mean everyone, has jumped on this bandwagon of, it's different this time. The 4-year cycle's over. We've institutionalized. There's too much demand, not enough supply. And it's true. We don't have enough supply of what's mined every day, but there's plenty of supply. There's plenty of people. Look, I want to believe that there's more demand and organic demand than supply, and that we're still on track for higher highs in Q4. I am concerned that the ripping out of the leverage that occurred on Friday and the destruction of that retail cohort may make that pretty impossible. Now, that's the bad news. The good news will be, since we didn't go to 170, we don't have to fall to 65. So we could now just chop around this level, and money devaluation, dollar devaluation is going to continue at about 6 or 7%. And so we should just steadily accrete. And so then it's just about a DCA, right? Just buy some, and you buy some today, buy some next week, buy some next month, buy some 6 months from now. And I think that's more boring, and people aren't going to like that because it's a number go up, but it's not a big number, right?
Yeah,
and
that's all right.
It does make me nervous that, as I affectionately call it, the Trump back whale, which is probably going to get me in trouble, but the Trump back whale is back short, and even bigger this time. You wouldn't, or you shouldn't, make that trade unless you have better information. Unless it's a market neutral trade, right? If they're long someplace else and they're short against it and they're just arbing the spread, which Absolutely could be.
Yusko doesn't rule out the possibility that we're entering a new crypto winter, perhaps earlier than many expect. But unlike past cycles, the downside may be shallower. Because leverage levels are lower and the institutional structure is firmer, he believes a major collapse to $60 or lower is unlikely. Instead, we could be entering a long period of consolidation where Bitcoin trades between $90K and $120 for months, slowly accreting value as global fiat currencies continue to debase by 6 to 7% annually. In other words, Bitcoin's return may start to mirror the steady, compounding nature of traditional assets, less volatile, less explosive, but still fundamentally upward over time.
If you think about the 4-year cycle, after the bear market, so after crypto winter, the price is below the value. Well, what do I mean by that? The value of any network can be determined actually pretty accurately with a Metcalfe's law model. We know the inputs, transactions and nodes and all participants and the wallet sizes. We know all of the fundamentals of this particular network or communications network or a cell phone network. And we can value networks based on Metcalfe's law. So once you know the value, when the price falls below value, because remember, price is not the value of anything. The price is simply what two people agree to sell a small amount. Mm-hmm. And this is one of the things that kills me about crypto broadly, Bitcoin less so, but crypto broadly. Let's just I'll just pick on it, Dogecoin. I could pick on XRP, but the XRP army is like angry. They get angry. So I'll pick on Dogecoin because they don't seem to be quite as angry. So the idea that you take the last 100 Doge traded and then multiply that price times the billions of Doge that exist, and that's your market cap, that's an insane number. Because if Mark Cuban or Elon Musk were to sell one Doge, that price would collapse. It might not go to zero, but it would collapse because the price is not the value, right? The price is just what two people exchange a small amount. Sure. And the same thing applies to XRP or anything where the bulk of the asset is held by a small number of people and there's very little float. Take Oklo stock or Rigetti stock, same phenomenon, right? And short squeezes can happen and all kinds of crazy stuff can happen. But at the end of the day, if the price, so when the price is below fair value, who would buy it? Investors.
Yeah.
That's what investors do. They buy things below fair value, or they buy things at fair value that they think can grow faster. So either a value investor or a growth investor. Okay, fine. So then what happens? The price starts to move up. So we get crypto spring, okay? And we get a little bit of recovery. Well, then as it starts to move and the halving occurs and the price starts to move back towards fair value, okay, then what happens? Well, then the traders come in. Traders, they don't care about value. They just want movement. They could be long, they could be short. So then as we get to fair value, so the price, gets back to fair value. Now what happens is we start to go above fair value. Well, who does that attract? Well, that attracts the speculators. Well, who are the speculators? Well, the speculators are the opposite side of the hedgers. Well, what's a hedger? A hedger in any commodity, whether it's oil or gold or silver or wheat or corn or Bitcoin, remember, is a commodity. The producers, let's say they're drilling barrels of oil, they need to sell the oil to pay their bills. Yeah. So they sell the oil in the futures market and someone has to buy it. That is a speculator. That's the definition of speculator, the opposite side of a hedger. Same thing here. The miners have to sell the Bitcoin to pay their bills. Now they could issue debt too, but many of them sell their Bitcoin and they do it in the futures market. Well, then we can get into the dirty little secret that, well, there's some other people that sell futures, like hedge funds. And I love when people say, oh, Millennium owns 2 billion of Bitcoin. No, they don't. They own 2 billion of IBIT and they're short 2 billion against it because they're a market neutral fund. Mm-hmm. So the problem is that short in the futures market puts artificial down pressure on prices. So the speculators, okay, some of them maybe aren't taking the opposite side of the hedger. Maybe they actually believe that the price is going to change. So they're going to actually speculate. So then the price starts to move above fair value. So in 13, fair value was 10. I'm sorry, in 17, the fair value was 10. We got all the way to 20. Remember, we hit 10 on November 6th, right on schedule. And then we went all the way to 20 by December 18th. I'm in the maybe not so vocal minority that believe that the 4-year cycle still exists and that there will be another crypto winter. And it's possible, I'm not saying probable, but it is possible, and I don't want this to be the case, but it is possible that we've already entered into the new crypto winter as of October 6th.
For long-term investors, Yusko recommends a simple strategy: dollar cost averaging. Buy some Bitcoin today, some next week, some next month. Over time, the noise fades, and your cost basis reflects the real long-term growth of the network. He concludes by warning against overconfidence in the new paradigm narrative. Every time investors claim the cycle is over, the market reminds us that human psychology hasn't changed. Greed and fear still dominate. And even in an institutional world, the 4-year rhythm of Bitcoin may still be alive and well. According to Mark Yusko, the truth lies somewhere in between. We might not see the euphoric heights of $170,000, but we also won't see the deep despair of $15,000 again.